Okay, let's chapter 14 in this text talks about bonds, bond prices, and yields. So we're going to go through an explanation of debt in general. And this is going to be broken up into several chapters, but throughout the rest of the course, we're going to talk a little bit about some pricing issues, some behavior of bonds. We're also going to discuss the concept of default risk and how that is addressed in the marketplace, and how interest rates have an impact on pricing. So let's think about what a bond is first. A bond is just debt. It is often referred to as fixed income because the payments, like loans, are fixed. You know what they are ahead of time. And again, it's just like any real debt with a bank, right? You're going to agree to pay a fixed amount of interest for a certain period of time. Unlike a bank loan, though, the payments that you make are interest-only payments. So the bond, the company that issues the debt, is going to make payments of current income. Typically, it's going to be semi-annually. However, for some bonds, they also do pay annually instead of semi-annually. And there will ultimately be some change in value as interest rates in the economy change. So there will be potential for capital gains as the company goes through the economy, right, as time passes. So why would you want to invest in bonds? The reason most people invest in bonds is for the conservative income that are paid to the investors. By conservative, I mean the coupons are known, they are fixed. Most bonds, as long as the company doesn't go bankrupt, you can pretty much be assured that you'll receive the interest and principal from this loan. Now, there are other types of loans, and there are other strategies that can be addressed. We could actually trade kind of more aggressively if we wanted to on certain types of bonds. Certain bonds have some tax-free features that we might want to take advantage of. But at the end, we really look at bonds primarily as a place to preserve our long-term capital, right? We want to preserve the base of the bond so that we can participate in the income from the bond. So what's the difference in performance? Well, if you look at the Vanguard's total bond market index since early in 1989, I guess, 1990, a $10,000 investment grew to roughly, it looks like here in the ballpark of about $45,000, where at the same time stocks ultimately have grown to much higher, up around $60,000. So there is a greater return potential for stocks. However, what you will notice though is that the bond rate is smooth, it is continually growing, etc. But stocks have volatility, and we'll address this when we talk about stocks. If you can't take this kind of volatility, then bonds might be the thing for you. However, you also have to be willing to accept a lower rate of return. So what are the basic features of a bond? A bond pays a coupon. That's the interest payment. There's something called the current yield. It's the current return if you buy the bond today and you receive the interest over the next year. The principal is the par value. For almost all bonds, it's $1,000. There's a maturity date. There are term bonds. They're the most popular, if you will, or most prevalent. They typically have a single maturity date. There are serial bonds, though. These are bonds that within the bond contract, they have a series of different maturity dates. So that within the contract, certain bonds will mature at the end of every 10 years. A note is typically a bond. However, it's issued with a much shorter time duration, typically 2 to 10 years. Bonds, on the other hand, can have a maturity date of 30 years. There is actually debt that has been issued with a 50-year maturity and a 100-year maturity. So bonds can have a very long time frame with which an investor can hold this type of security. All of the rules associated with a bond are incorporated in what's referred to as the indenture. It's a contract that sets the rules of borrowing. So let's think about pricing behavior for a couple of minutes. The price of a bond is a function of the bond's coupon, its maturity, that is how much life is left in the bond, and the level of the market interest rates. A premium bond is a bond that sells for more than its par value. This typically happens when market interest rates fall. As interest rates fall, prices rise, and they can rise to above the $1,000 par value. The discount bond obviously sells for less than par, and this happens typically when interest rates are rising and they rise above the bond's coupon rate. So they've gone above the current yield, essentially, of the bond. So the maturity of an issue has a little bit of a greater impact on price than the coupon does. And what we'll see later on as we look at some more of this information, we'll find out that prices of bonds that have longer maturity are much more impacted by changes in interest rates than shorter term bonds. And we'll take a look at this towards the end of this material. So the behavior of interest rate is the single most important force in the bond market. Now that's not to say that there aren't other things that affect the risk of a bond. Certainly the riskiness of the company is going to have an impact on the risk of the bond issue itself. And if companies get into trouble, then the risk of those companies go up and the value of the bond will go down. But that's a lot harder to measure how that impact is going, or how that's going to find its way into the bond price than to think about interest rates, because interest rates are part of the formula for the value. So again, interest rates and bond prices move in opposite directions. If interest rates are low, we say that bond markets are bullish. That would mean lower interest rates mean higher bond prices. That is a bullish market. And of course, a bearish market is the exact opposite. That is typically when interest rates are high. Currently, we have relatively low interest rates in our economy. So the bond markets are typically what we might refer to as being in a bullish state. Bond prices are typically high. So what kind of risk are we exposed to when we think about buying bonds? We've already talked about interest rates, right? When interest rates, this is what happens to negatively impact bond prices when interest rates change. With bonds that have a very long life, they are also subjected to inflation risk or purchasing power risk. This is going to reduce the value of what a bond is worth over time in real terms. Business and financial risk. This really has to do directly with the company. What happens if this risk changes? That certainly is going to have an impact on the expected returns an investor could receive with a particular bond. Liquidity risk is a challenge with bonds because they don't trade as easily as stocks do or as readily as stocks do. So there's always a little bit of a risk that it might be difficult to sell a bond when you want to sell a bond. There's also something referred to as a call risk, and a call risk is a mechanism, or a callable bonds, are a mechanism that a corporation can use to refinance its debt and or just to retire the debt prior to its scheduled maturity date. And we'll talk about how this has an impact on value and returns, again, a little bit later on in this video. So how do we quote prices, or how do you find the prices of bonds? When bonds are actually in the financial press, when you see them print the returns or the information about a bond, typically they translate into percentages. So for corporate municipal bonds, they're priced in decimals. So if it's 87.562 is the quote, if you move that one decimal place to the right, that's $875.62 is the value of that bond. For United States treasuries and agencies, for some reason, they are stated in 30 seconds of a point. So 1 point essentially equals $10. So I guess that's why the 30 seconds is there. So a bond that's 94.16 is really 94 and 16/32, 94.5%, which means that bond would sell for $945. So the price of the bond is dependent on its coupon and maturity. So these are usually incorporated, of course, into the pricing quote. So in other words, the quote includes what has happened to the bond historically over the last maybe couple of days, but the price includes coupon and maturity. It's in the formula, as we'll see here in a little while. We mentioned something called a call feature. A call feature is part of a bond, but it has to be stated in the bond. In other words, there are essentially two kinds of bonds, if you will. There is a bond that you can buy that the company guarantees to make interest and maturity payments until the bond matures. There are also bonds referred to as callable bonds. These bonds have a feature that's stated in the indenture, in the contract, that this bond could be called prior to maturity. Now, it could be freely callable, that anytime they could call this debt, or it could be a deferred call. Essentially, what this says is when they issue the debt for the first 10 years of life, the bond is not callable. It's non-callable for the first 10 years. But after the 10th year, any time after that, the bond could be called. Now, how this works essentially is the corporation wants to refinance its debt. So when interest rates have fallen substantially, we're going to find that bonds want to refinance, just like consumers want to refinance their debt on a mortgage, for instance. If interest rates start to fall, it might make sense to lower the cost of financing if they can get a lower interest rate. That's what this call feature is for. Now, essentially what happens is there's something called a call premium. This is how much is added to the par value and paid upon the call to compensate bondholders. Typically, this is the call price. Then will be the bond's par value plus the call premium. Essentially, the way this works is when a company wants to call its debt, it's in the contract, it's in the indenture, it tells you what this price is. Typically, it's the par value plus 1 year's interest. So a 10% coupon bond would essentially cost $1,100 to refinance and to pull this debt back to the company. Now, how they would do this is they would go out typically and borrow the amount needed to buy back the entire debt. Just like you do when you refinance a house, you go out and you borrow what you owe on the house, use that to pay the mortgage that you currently own. There's something called a sinking fund, and most bonds have these things, but what they basically do is they require bonds to, it's not a technical finance term, but they require them to squirrel away some money. If you think about it, a company is going to borrow $100 million in 30 years. 30 years from now, they need to have $100 million in their checking account to pay off this debt. That's very difficult to do. No company is going to be able to acquire that much money in their checking account. No company is going to want to acquire that much money in their checking account. So what they will do is they will set aside some money. And this money will sit in this account, if you will, and will earn interest. And the idea is, again, roughly, not taking into account time value of money, maybe it's a 30-year loan, so 1/30 of the debt is put away in this sinking fund every year, so that by the end of the time frame, they would have the entire amount in an account. Now, what they typically would do is they just won't sit there. What they will typically do is systematically buy off the debt. So they'll go out to the marketplace. Certainly this would work, if the bond prices were really low. This would work. It'd be a great time for them to buy back the debt of the company and reduce the ultimate payoff when the bond matures. So again, this is just an amount that's set aside systematically, and quite frankly, the bondholders want this so that in the end, they don't worry about having this big payoff and the company not having the money there when for the payoff. We can also identify bonds by what's referred to as seniority, right? A senior bond is a bond that has security. It has collateral. There are several types of these. Mortgage bonds are secured by real estate. Collateral trust bonds are secured by some financial assets that are owned. Maybe it's an investment portfolio that the corporation has. There are also equipment trust certificates. This is kind of like a car loan where the car is the security for the loan. And there are also some first and refunding bonds, right, that are a combination of these different types of security levels, if you will. And they're a little bit less secure than a mortgage bond might be, but they're in an order of payoff, if you will, of security. So all of these bonds reflect some form of security. Junior bonds are what are referred to as unsecured debt. These are bonds that are backed only by the promise of the issuer to pay back the debt. So we've referred to these in the corporate context, we refer to these as debenture. Again, it's basically, there's no collateral, the corporation just promises to pay. Now, as the company issues more and more debt, where do these bonds line up? There's something referred to as subordinated debentures. These are bonds who are further down the list, if you will, of payoffs when if a company were to go bankrupt, for instance. An income bond is a bond. It says here it's the most junior of all bonds, and essentially it only pays if the project for which the bond was issued to buy, if that thing earns some money. So if it's out there and it's outstanding, it will only pay if earnings are acquired from this particular project, if you will. So we refer to that as being the most junior of all bonds. So that's the end of part one. There's going to be several parts to this chapter. So I'll see you in the next section.